Welcome to Coldstream's Investment Strategies Group's webcast. My name is Howard Coleman. I'm the Chief Investment Officer of Coldstream. And with me today is David Powers, the Portfolio Manager for Roger Reynolds' team. We will be providing a market recap and discussing our special topic, which for this call was on recession. Are we there yet? We will discuss where we are in the economic cycle in the U.S. and globally. We've scheduled this call for 30 minutes. But please bear with us if we run over by 10 to 15 minutes so that we can cover these topics for you. Now for the market recap. This chart shows the asset class returns both for the US and internationally in both stocks and bonds. And as you can see in the right-hand column for 2018, it was an historically bad year for the breadth of the downturn. In other words, the S&P was down only 4%. But every asset class, pretty much every asset class in the world, with the exception of the Barclays Ag, which is U.S. Treasuries and investment-grade bonds, was down for the year. And the Ag was only up 1 basis point, 1/10 of 1%. So it was a very difficult year last year, and it was made worse when you're thinking about it by the fact that from its highs, the S&P was down 20% because it had a very good first half of the year. For Q1 of 2019, the market recovered very nicely, the S&P being up 13.65%, which was the best year that the S&P has had in 21 years. The U.S. outperformed internationally, and that really has been the case basically since the great financial recession. Year to date, we're up 15.77%. Now that's as of Friday. In the S&P, we of course were down about 3% today, but still a pretty healthy return year to date. Now, we saw on Monday a drawdown and concerns over tariffs. The one point I do want to make that's I think important to keep in mind is even in great years in the S&P, we have significant drawdowns within the year. And the black bar shows how much we were up or down during the year, and the red dot shows the largest drawdown during the course of the year. And as you can see, in even up years, there are significant drawdowns. In fact, the average drawdown in a year is about 13%. So we do have concerns around tariffs, and we'll talk about that later. But it is important to keep in mind that these type of drawdowns that we've seen so far in the last few days are not abnormal, and in fact, over the course of the year, you can expect a larger drawdown than the 5% drawdown we've seen year to date from our highs.
So this is David Powers. I'm going to take the equity portion of the market update and then flip it back to Howard to talk a little bit about the credit markets. But right here, we're starting with the S&P 500, which obviously represents large cap stocks, and we've got the chart that goes back about 3 years here. You see a few lines, the black line being the actual index, the blue line being the 50-day moving average, and the red line being the 200-day moving average. You've heard us talk about the technicals quite a bit, but I think in this particular run-up, certainly since 2016 when we had our last roughly 20% drop, the technical environment here has been fairly orderly, where you could see we've held the 200-day moving average for the majority of the time. That kind of broke down as we entered the fall or in that October month, skipped rope with it for a little bit, and then finally started to move down where we headed towards that 2400. That 2400 was actually important because if you go all the way over really to the right-hand side of the chart, you can see there is some consolidation there. So the fact that we had a cup of coffee just under 24 and we're able to bounce back up, I think for us is very encouraging. And then from there, we've got very healthy from a technical standpoint. We're able to get that golden cross where you get the 50-day to move over the 200-day to the good side. And then even in some of the down days, we've been able to hold the 50-day moving average. Now, this is going to be tested. Obviously, today, I think we went through being Monday, we went through the 50-day moving average and are a little bit ahead of the 200-day average. I think this is going to be something that's close to watch over the next week or so as, hopefully some of this tariff talk gets worked out, or at least we get some direction, because unfortunately, once you go through the 200-day moving average, again, there's really nothing to stop the market until we head back over into the 2400 range. But for right now, we're holding those important technical levels, and hopefully that will continue. I think one thing I'll note also on this chart, though, is that we failed to really make any meaningful new highs as we approach the top. And so you can see we've kind of topped out there at right around that 2,900, 2,920, which is the second time we've been able to do that if you squint. And for that reason, we're going to need some type of catalyst, I think, to move that over. But it has been about 15 months now since basically, if you look back, the market's gone somewhat sideways. Actually, I was listening to Jeff Gunlock, and he made that comment that the market hadn't gone anywhere in about 15 months. And I was a little bit surprised. So I went back, and obviously he doesn't lie a lot. So I believed him in his comment. But then I went back and looked at the entire, this entire cycle. And was this something that was prevalent in the other downturns that we had? Howard?
Yeah. Can I just make one more comment on this topic, and that is the technicians will look at three tops in December of 2000, little after December of 2017. That might be January 2018, September of 2018, and currently. And that triple top is a somewhat concerning indicator, and hopefully we will be able to break through with that. That's just emphasizing David's point that we reached it, not that. We reached it and fell back this time, and it's the third time that's happened.
So moving on to the next chart, actually, again, taking a look at the whole cycle. This goes back, obviously, to the beginning of 2009 when the market started to recover. And we did have bouts of roughly 20% declines in 2011. We had it between 2015 and early part of 2016. And now we're currently having again at the latter part of 2018. And you'll notice that I just crudely put some black lines there and some time frames. But you can see this isn't uncommon for this particular cycle. This will be the third time that we've had it. So obviously, as we head into a seasonally quiet period, would not be surprised. Again, we can hold these technical levels, but we wouldn't be surprised to see another 2, 3, 4, 5 months where we can continue to grind sideways. And I don't think there's anything wrong with that, because then obviously it could set us up for probably a back end of the year or some type of surprise. I think the concern for me is what's the catalyst to get us to that next 10%. We can certainly go marginally higher once we get to the top again, but what is the catalyst to get us that next 10, 15%? For me, perhaps it's some big earnings surprises, and that they're certainly out there. I think the guidance has been relatively weak for the majority of the year, so that could set up some very good opportunities. But I'll flip it to Howard. We had the topic, I asked him the question earlier this morning, what he thought of the catalyst, and then give him an opportunity to speak on it.
Yeah, I think the catalyst, one catalyst would be if there was a significant infrastructure bill passed out of the House and Senate that was signed by the president. And I was skeptical of that actually happening, given how hard it is for Democrats and Republicans to agree on everything. But perhaps because of the China dispute and concerns about growth right now, that might become more of a possibility. The other thing I wanted to mention on this chart is I talked about triple tops, but as David has shown, we've really had those triple tops before. So technicians are right, but not right all the time. And even in this, what we're looking at here is a significant bull market, and we've had those flat periods in the bull market. The fact that we have these flat periods does not mean that this market run has come to an end.
No, actually, I think they're healthy because it does provide some consolidation and gives us a little bit of runway to keep this going. But moving on to the next chart, just taking a look at what does get the market going forward. We don't have pictured here today any earnings, but I will say, at the beginning of the year, I think earning expectations were coming in at about 12%. Those have been materially ratcheted down to a little bit north of 3%. That isn't terrible. Given last year earnings came in over 20%, it's very difficult on a comparable basis to really beat that in an economy that's only growing 3%. You would need something, I think, much more meaningful. But the fact that we still do have positive earnings growth, and we think there's a bigger opportunity for upside surprise than there is further downside surprise. So for that, I would look at it as encouraging. And now you're taking a look here that we have valuations. These are the forward PEs. There's some other valuation metrics up there. All of them are reasonable at this particular moment. I wouldn't say the market's, based on this chart, is expensive or cheap for that matter. The one thing I will note, though, is when you generally get late in this cycle, to expect margin expansion to be the reason for your next big leg up, just more demand, and that pushes stock price up, I think it would be challenging, to say the least. I think you do need fundamentals to be able to drive this. So I think so for me, that's why earnings, I think, are a big factor in what we can expect for the remainder of the year.
Yeah, the only additional comment I want to make is if you look at the far right-hand side of the chart, the most recent, you saw in the in the December market difficulties, valuations come down, and this year they've come up to a little bit above average. And a great part of the return this year has been multiple expansion in the S&P. David said, and I agree with him 100%, that relatively corporate profits have come in nicely, but the rise in the S&P really has been multiple related.
And well, I'll say that the one thing, maybe a little bit of pushback there, the caveat to that is last year we did grow at 20%. We had a down market, and that's that's rare. I've given the math problem in many talks, certainly with my clients, but also in a larger forum. It's the way you get returns is you get earnings growth plus dividend yield, and leaving valuations the same. And that obviously that math problem didn't work last year. So even though yes, it equates to margin expansion, I do think that you're probably playing a little bit of catch up after what was a very strong year in 2018.
I completely agree.
Just a couple quick charts on the international side. Howard obviously mentioned that they're still lagging, and you could certainly see that here. When we look at international developed, which is represented by the MSCI EFA, you could see that from a technical standpoint, yes, we have gotten healthy. The Golden Cross exists here. We've been able to hold the 50-day. Again, we'll get that test. The 200-day will get tested here, I think, over the next couple days. But one thing you will notice is we have not even gotten near back up to the highs that existed back in January of 2018. So overall, even though we obviously have healthy returns, I think Howard showed 11% return for EFA in the beginning of the presentation, we still are well below what we would consider tops at this particular point on the international developed side. And when you look at from an emerging market standpoint, I think the story is very similar here. One thing I will note about the emerging market is this has been, to me, the most technically sound chart, where basically if you just start at the far right and just follow the 50-day moving average, any decline, certainly at the beginning of the chart as you go into the middle, you could see we held the 50-day moving average in the upturn, and then subsequently on the downturn, we could not overcome it, and that persisted for quite a while. Finally, we were able to get above it, and the same process started. Now, this is the first time we've gone back below that, and it seems emerging markets has kind of been the leader in the up and the down in this particular move, and so it'll be curious to see how they're able to hold up during this period of time.
Just one technical point on the MSCI Emerging Market Index. This tracks the index, the MSCI index, and that index is changing in the fall. To the extent that A shares, which are local denominated Chinese A shares, stocks to trade on the Shanghai and the Shenzhen stock market in China, have not been a significant portion of the MSCI Emerging Market Index. It is going to become a more significant portion. So the nature of this index will change somewhat at the end of the year.
I'll go back a slide there. I had one out of order, but you can see here now we have global valuations where we're comparing the U.S. You'll see the DM, that's developed markets, which is represented by the EFA, and then breaking out Europe, Japan, and then you can see EM on the other side, which uses price to book as a better metric. But you could see, in all the areas, they're in and around where their 25-year history would be. And so even though there's obviously some relative opportunities in the developed ex-US and in Europe or Japan and even EM, we're not really at valuation levels that we would consider cheap at this particular point. It does look like across the board, everything just seems to be fairly valued at this point. So to expect that margin expansion again, or that multiple expansion, again, it would be a little bit challenging in this portion of the cycle. So Howard's going to take a quick look at the credit markets here, and then we'll get into the special topic.
So let's look at investment grade spreads. And when we talk about spreads, what we mean is the difference in yield between investment grade corporates and treasuries. Treasuries are considered risk-free. So the spread that you're looking at is what's the risk of taking an investment grade corporate bond over treasuries. And when yields widen, that's generally a sense of risk, of the market being concerned and risk being on. When they tighten, the market is less concerned with potential defaults, and it's considered a risk-off trade. It also, with investment grade bonds, can also be a view on interest rates, because the coupon on investment grade bonds is lower than high yield bonds. because they're considered safer, so you get less reward for investing in them. They are more sensitive to interest rate rises. So if you can see, for example, when people were concerned in the beginning of 2018 in particular, that the Fed may be raising rates, those spreads widened. And this year, as the Fed has been taking the foot off the gas and risk has come off, those spreads have narrowed. I imagine over the last couple of days, given the concerns about tariffs, there's probably spread widening a slight bit. But they're not at cyclical tights. They're not a screaming buy. They're somewhat tight, but it's not something that we are interested in overweighting in portfolios at the current time.
Yeah, I take a look at this chart as well, and going back to the equity markets, and you can look at the S&P 500. It's not a surprise that when the equity market started to decline, those 20% or in and around 20% corrections, you also saw spreads start to widen. So it's obviously moving into investment grade, isn't an elixir in terms of where to put capital in a risk-off type of environment. And I think that's something that needs to be noted. I'm guessing the next slide is going to focus on high yield, and it's going to show the same thing, but I don't want to give away the
yeah. So high yield shows the same thing in the sense that spreads are tight, but they're not at cyclical lows. They've been tighter. The important thing to remember about high yield is it responds to different things than investment grade. Investment grade very much, as I said, responds to interest rates. High yield bonds, although it has some relation to interest rates, is very much more equity-like because you are investing in more risky companies. So the bonds of those companies look not completely like the bond of investment grade, not completely as risky as equities, but somewhere in the middle. So when equity markets sell off, high yield will sell off not as much, but it is equity sensitive and not quite as sensitive to interest rates. So you will see over the course of this year, as the equity markets rallied, so did high yield markets. And at the end of last year, as equity markets sold off, spreads widened again. That big widening you see in 2016, at the beginning of 2016, that is oil related. Oil is about 20% of the high yield market. And if you remember, oil prices were very, very low, and people at that time were worried about the solvency of oil companies. And that's why you saw that wide spread. We don't see anything like that happening in the near future. This chart is on municipals. And this has been, this chart is highly, highly unusual. What this chart is it compares on a tax neutral basis the value of treasuries versus the value of AA general obligation bonds. Typically, you will see at some point AAs being more valuable than treasuries because the risk of default of a municipality is higher than the risk of default of the federal government. Here, you're not getting the value in AAs that you're getting in treasuries, and that is because there has been constrained supply and enormous demand for municipals. And the demand has in large part been caused by the elimination of the state and local tax deductions on the Tax Act. So people can't deduct their state and local taxes, so they're investing in munis for a tax-free yield. And you are really seeing this in high tax states, especially California and New York. But munis are very rich, and this chart is showing that even going out to 30 years on a tax equivalent yield, munis, you're not getting the same yield for munis as you are on treasuries.
So now on to a special topic. Obviously, we chose recession. The beginning title, Recession, Are We There Yet? The quick answer to that is no. We don't think that we're near a recession at this particular point. But, and obviously in reference to the title, to say that, it's in the room. And regardless of whether you think it's 12 to 18 months out or something's below or beyond that, you need to start paying attention to this stuff 6-9 months in advance if you really want to have an impact on the portfolio. And so obviously that's a very long-winded title, and so we just decided to go with the one, are we there yet? And just answer the quick question, no. But there are 5 things that we're paying close attention to, in terms of, analytics. Some are pointing closer to recession than I think most people are giving them credit for. Others are still looking pretty good, and we're going to try to unpack those. We go into a lot about the leading economic indicators, or the LEI, so I don't want to disappoint there. So we're certainly going to touch on that. Then Howard's going to touch on central banks and what we're seeing on the yield curve. We'll discuss a little bit about global growth with a specific focus on China. And then for the seasoned veterans out there, we'll give a little talk on oil before we wrap up. But moving on, just quickly on GDP, because we did get the number over the last couple of weeks. It was a big surprise, came in at 3.2. Obviously, there's a lot of lines on this chart. We have the Atlanta Fed, basically, which is the blue line. We pay close attention to the Atlanta Fed because it's a dynamic index. So as the data comes in, the line moves and kind of gives us a better indicator of where we are in the current quarter. And you can see by the arrow there that they were looking at about 1.7 or so, which on its face isn't a terrible first quarter. If you think historically, certainly the last 4 or 5 first quarters have been very challenging here. I don't like to blame the weather because weather happens, but obviously the first quarter does have some seasonal factors to it. But we did have a blowout quarter, rising 3.2 compared to most of the estimates. The other one is the New York Fed, which was a little bit below that, and that's the red line. But again, a really good quarter. Now, there were some first one-time items in that. There was an inventory build, and then also imports went down, and so that cost about 1.2. But even if you want to be pessimistic and strip that out, we still grew at about 2% in the first quarter. I think that's a really good number. Some of that may bleed into the second quarter, but I think it does set us up for a pretty good year if we're sticking to historical norms here. So I think getting the first quarter out of the way with a solid data point, I think is checkbox number 1, that we're not concerned that recession is a 2019 issue at this particular point. So moving on, talking about these LEIs, or leading economic indicators, and they are not signaling a recession. Now, there's a lot on this chart that I want to talk about here, so please bear with me. The first thing notice is just as a reference point, you'll see some gray lines or bars. Some are thicker than the others. Those are basically our recessionary period times. Not surprising that the red, it'd be a negative change, and those are generally smack dab right before or in the middle of a recession. And then you see the blue is the green is the positive change. And I think this is where we want to focus our attention on at this particular point. One thing you'll notice, and if you go back to the right side of the chart and go all the way, you'll notice out of recessions, we generally have our biggest move up in these leading economic indicators. And we have this on a 6-month roll to kind of give us a little bit more of a smoothing aspect to it. What ends up happening is then over the next couple of years, that growth, while we're still growing, grows at a slower pace. And as you get closer to that zero bound line, you generally get some monetary or fiscal stimulus at that particular point, and leads us to that second leg up in leading economic indicators. And this time around was no different. And you can see that certainly kind of in that 2013 range. And then we moved up, and the second move up is never as big as the first one in general. And then again, you start to roll over. And this happened in 2016. We got right to that zero bound line. Obviously, we brought in a new administration, more business friendly. Taxes were going to be a little bit more friendly, and certainly could have provided us with that third leg up. And you can certainly see that. Now, the third leg up in this particular chart is a little bit rare. I think if you go back to the 90 section of this chart, you'll certainly see this. This is why I certainly equate a lot of what we're seeing to late 90s type of behavior. But we peaked out in June of 2018, and we've been steadily rolling over. Here now we're down about 1.2. So we've gone from about 3.5 to 1.2 in roughly a 9-month, 10-month period of time, which in itself is a pretty decent pace. It looks obviously like it's a pretty stark slope down, but it has been fairly measured. But again, we have now approached 1.2, which is a lot closer to 0 than 3.5. And so as you head to the zero bound line, you have to kind of look at the history and say, well, what's next? You'll notice that we don't have a fourth leg up in these leading economic indicators. That doesn't mean it can't happen. That doesn't mean we're not rooting for it. But from a historical standpoint, it is not something we've seen. So when we think about, is recession in the room? I think the answer to that the question is yes, because if this continues down at this pace, you basically hit the zero bound line, somewhere at the back half of this year, probably mid-fourth quarter. And then if you look at the lead times before recessions, they vary. There's no doubt the earliest being 2 months and the latest one being 15 months. But again, do you really want to be in the spot to guess what the lead time is going to be before you hit that. And so for, looking at the LEIs, which to us is probably the most important, there are some signs here that are starting to concern us. Now the 6-month roll, now keep in mind what that has. That's October through, right now, March. So basically the third and the fourth quarter in full. The fourth and the first quarter in full. And so you're going to be rolling off some pretty bad fourth quarter data and adding in some second quarter data. So I think the next 3 months in terms of what we get will be a very good indicator on when maybe we can start the clock ticking on the R word. And so we'll see how that comes in. But it would be nice to see this kind of level itself out here over the summer months and give us a little bit longer before we have to start making any meaningful adjustments to portfolios.
Just one couple comments on that. I think it's maybe inherent in what David said, but I want to emphasize this, that of all the signals that we look at in terms of recession prediction, LEI is number one. It's been a very, you don't have a recession without the LEIs rolling over. Sometimes, as you can see on the chart, the LEIs do roll over and you don't have a recession. Those slight periods in the late 60s and in the late 90s. But it is a very accurate predictor with the lead time that David referred to. In the upper left-hand box there, you can see the lead times. I think that these rolling overs, and I'm speculating here to some extent, are some of the reasons that the president and the administration is pushing the Fed for a rate cut, because I think the last thing they want to see is us fall into recession in the middle of election season, and they think Fed stimulus might be a way to prolong it.
Could not agree with that more.
This is a chart on the Fed Reserve versus market expectations, and this deals with rate hikes and what the market is predicting on rate hikes. And you can see in the left-hand chart, this is in 2018, what the market was predicting back to 2016 and what the Fed rate hikes would be. And you can see in that period, the market really was under predicting what the Fed actually did. And what the Fed actually did is in the last chart there where it says September 18. More recently, the market has been right and the Fed has been wrong. And when I'm talking about the Fed it's what's called their dot plots. And at their meeting, they say, this is what the Fed governors think interest rates will be. So in the left-hand chart, it was what the Fed governments thought interest rates would be in September of 18, beginning in 2016. And then in the next chart, beginning in 2017, what they thought it would be in 19. And today, it's 18 to 2020. The blue line's what the market thinks. The black line's what the Fed dots think. And you can see in the middle chart, the market was right in the sense that the Fed was overestimating the number of hikes. Right now, you can see that the Fed is at 0, but the market thinks there's going to be a cut. And the market thinks there's going to be a cut, and that relates, I think, to, again, what the administration wants and the LEIs beginning to roll over a little bit. This is what central banks are doing. And if you remember last year, and in large part, the reason for the market going down when corporate profitability was so good was people were concerned about the Fed raising rates. And the Fed indeed was raising rates into 2018. And so was the ECB. They were cutting off stimulus, and even the Bank of Japan, not raising rates, but they were stopped shrinking their balance sheets. All of these economies, all of these central banks stopped shrinking their balance sheets, and the Fed began the rate hiking mechanism. The ECB did not begin rate hikes, but they did shrink their balance sheet. When I'm saying shrinking their balance sheet, what I'm talking about is central banks were actually out in the market buying bonds. And in fact, in Japan, they were buying equity indices, and they were supporting the market. And as they stopped buying and as balance sheets shrank, the concern in the equity markets rose that the Feds were not going to be as supportive. That has stopped now, and that will be perhaps a wind at the back of the economies. This is the yield curve. and this is the yield curve in 3 different time periods. 1 year ago, 90 days ago, and now. And the red line is now. And what the yield curve is it's the rate for Treasury securities beginning in 1 month on the left-hand side, going out to 30 years on the right-hand side. And we can see that throughout the curve, rates have gone lower. On the short end, they've gone a little bit higher over the last 90 days, but overall, they're significantly lower. And the thing to focus on here is the difference between the 2-year in the red and the 30-year, in the 10-year. The 2-year, 10-year spread, the second best indicator of a recession after the LEIs is if that 2-year, 10-year spread inverts. In other words, if the 2-year rate is higher than the 10-year rate. It is very flat right now, but it has not inverted yet. It's something that we keep a close eye on.
Yeah, and in terms of how curves look in a Fed rising, when they raise interest rate, this isn't uncommon, for it to get very flat like this. So again, outside of the obviously extreme flatness at the 2 and the 10 level, the fact that they haven't inverted yet, I think, is certainly a positive in terms of not getting the clock just started on the recession talk just yet.
And as I mentioned that we think this is the second best predictor, this shows when the yield curve inverts, when it goes below the 0 line, and then the dark gray shaded area is when there is a recession. And sometimes, again, it reverts without a recession, and those are the red dots you'll see on the line. The gray dots are when they revert and there is a recession. And as David says, it flirts many times with being flat without going into a recession. And sometimes when it slightly goes in negative into inversion, it rebounds. But we are flat right now, and it's flattened significantly over the last few years. But we're not there yet. And again, once there is an inversion, if you look at the chart on the kind of the right lower part of the chart there, it still is a significant period of time before you go into a recession. The average is 14 months from the time of inversion to a recession. So again, we're within shouting distance perhaps, but we're not there yet.
And again, if you look at 94, you can stay flat for a considerable period of time. I think that's important to note here. I think the 94 examples, 94 to basically 99 or 2000 is a good example. That's roughly 6-year period of time where the curve just didn't move, but it was flat. And we're probably, if you want to make that case, we're probably about 2 or 3 years into that. If you think about the Fed starting their tightening cycle as the beginning, so again, these relationships can hold for a significant period of time. But it's why we brought it up now, because I think we're getting to the areas where it's something that you need to pay attention to. But again, I don't think there's any reason at this current time to kind of start the clock. And so a little bit of focus on global growth. And again, we're kind of ticking these down in order and kind of how we feel, starting with the LEIs and then moving to central banks and then the yield curve, and now focusing a little bit on global growth. I think it's important to note that what goes on globally, while important, we've never inherited a recession from a global standpoint. So if other nations or regions do go into recession or slow considerably, the impact here, in the U.S. isn't as dramatic. I think this chart shows that. Certainly we're still growing at 3.2%, while other nations, Japan, most of Europe, and then breaking out France, Italy, and Germany, are all in a very slow growth period of time. Now, there's been some deep positive news that have come out in terms of some upticks in various regions, but you got to keep in mind going from 0.2 to 0.4, while mathematically is a fairly large increase, on an absolute level isn't really all that significant. And so these economies have been going pretty low here for a while. But again, the U.S. has been quite strong, 18 being that, and then obviously getting off to a good start this year. So I think, global growth does matter, but certainly I think what we do here domestically trumps that, no pun intended, in that regard. But one thing, when you take a look at the global growth side of things, it is not accelerating. You can obviously see that when you take a look at the big three being Germany, Italy, and France, and of the Eurozone, you could see that those have been consistently rolling over now. to the point they're on close to that zero bound line. So we're not getting the help from the global partners that we think we need. And again, it comes back to that: what's going to be the next catalyst to get us going? And right now, certainly from a global growth standpoint, we're gonna need some type of turnaround to be able to use that as an opportunity. I think Howard's got a comment on the.
Yeah, I do want to make a comment on Germany. Germany is extremely trade dependent, far more trade dependent than the U.S., both Germany and Japan. And if this tariff issue affects China's growth, Germany may well be impacted even more than the United States because they are extremely dependent on China. The second point I wanted to make is that the ECB is changing leadership soon. Draghi's term is coming to an end. Draghi has been very supportive, using the ECB to prop up markets. His predecessor, Trichet, was not. And I think one of the things to keep an eye on is who will replace Draghi and what are his views on economic stimulus.
There's one last chart on the growth side of things, and Howard's going to talk a little bit about what's going on, from a China standpoint. But you could see that this is the heat map. This is the PMI Purchasing Managers Index, diffusion index. Everything above 50 is considered expansionary. Everything below is considered retraction. But you could see, obviously, when we look at the end of 2017 and 2018, the glory years, if you will, you can certainly see that we've cooled a bit and headed towards more of a lime green, as opposed to that darker Kelly number. And obviously in the U.S., we're still at about 52.4. Now we'd consider that expansionary, even though it's rolled a bit. But obviously, when you take a look at global or you take a look at domestic developed markets, ex-U.S. and EM, those are flirting with that 50 number at that particular period of time. And obviously that coincides with the rollovers that we've seen from the global growth standpoint.
I wanted to talk a little bit about China, obviously because tariffs are in the news and because China is such an important part of the global economy. China has experienced recently significant reduction in growth. That part of that slowdown has been intentional because the economy was extremely leveraged, and the central bank of Japan and the leadership, of China, and the leadership of China have wanted to rein in that deleveraging. That changed about 2 months ago when they decided that the slowdown was a little bit too much, and they began leveraging up the economy again. With these potential tariffs in place, we expect more stimulus, and we also expect, and we're already seeing it in the market, a significant devaluation of their currency, because if their currency is cheaper and therefore cheaper for U.S. consumers to buy with U.S. dollar, that minimizes to some extent, not completely, but to some extent, the impact of the tariffs. Because if tariffs obviously go up 25%, but their currency devalues by about, let's say, 10%, that minimizes the impact. So we expect that they will be trying to offset some of the tariffs by additional stimulus and certainly through currency devaluation. This is a chart I wanted to show because I think it gets very much at the heart of some of the conflicts we've had with China. And it is really an amazing chart. It's an historic chart. You're looking at 1980 to 1984 on the left, which is the end of the Maoist regime, when China was not a player at all internationally. Once Mao died and Deng Xiaoping became premier, and they tried to institute some capitalist principles, you've seen an enormous expansion in that economy. It's actually an historic expansion. And they are now almost 20% of global GDP. And PPP is purchase power parity, and that's just an economist mechanism to equate various currency differences and make those currencies equal in value. So if you strip out the currency effect, they're about 20% of global growth. global GDP. We'll see in a minute, they're a higher percent of global growth. We, of course, are the leaders in global GDP by a long shot, but they are now second, and it is a significant competition. Some of that global growth, some of that GDP growth, I think certainly Donald Trump would say, has come off the back of U.S. workers as jobs have shifted to China. But it is clear that they achieved this global growth through an export economy. They were focused on manufacturing and cheap manufacturing, exporting. It has been a goal of the Chinese Communist Party for the past 5 or 6 years to change the nature of the economy to become more like the U.S. economy. And the U.S. economy is much more dependent on consumer demand, internal consumer demand, and they want that because they want to be less exposed to external economies. They have not really been able to achieve that. And with this slowdown, when they tried to juice up the economy again, they went back to the manufacturing model and less to try to promote that services model. But it is interesting to note that in some ways their stated goals are consistent with the U.S. goal, which is stop doing cheap exports and change the nature of the economy. They just have not done this yet.
I think the other thing here is, you kind of look at, again, just to tie it back to the topic here of, the recession talk. The other recessions that we've had, certainly in the U.S., China was obviously not that big a player. You can look at the ones in the 90s, and obviously this chart, if we were to continue to move it to the right-hand side, would not show that they were a big player during the 70s. But certainly now this is the first time where they are a big player on stage, and as a global slowdown occurs, it could potentially have a little bit more meaningful impact than perhaps we've seen before. I think this is the first time that someone else has been on the global stage that could slow down, that could have a little bit more meaningful impact than in previous recessions.
And this next chart will show that. And the red in this chart is China's percent of global growth. So this is not just plain global GDP. This is the growth in GDP. And their percentage in global growth is 44% of total world growth. You can see the U.S. is the other major player, and the rest of the world kind of equals the U.S. So we are the two big players on stage as a percentage of global growth. The rest of the world has done better recently, but we're the two players. And if we slow down and China slows down, the rest of the world will slow down. I prepared this chart a week ago when it looked like a trade deal was imminent to talk about the benefits of a trade deal and the savings that would result from it. So we'll just kind of look at the reversal in the event that these trade tensions continue. But in the left-hand column, these would be the savings from the removal of existing tariffs, and that's potential significant savings. The middle 2019 would be the savings from avoiding further escalation. That's about 150 billion. And the right chart is what the total savings would be to end the escalation of the trade dispute. Of course, those savings will be gone, and those will be cost to both of our economies if this continues. I think it's clear, and I think both the Chinese and the U.S. would both admit that it's in both of our interests to strike a deal. But we seem to have some sticking points that hopefully we will get resolved soon. The last point I want to talk about is oil. Very briefly, oil does not cause recession, but it does cause pain and concern, and really reflects what thoughts are in many ways of what, it's A, supply demand, and B, looking ahead in the future in terms of what consumption will be. And we can see a very high spike in oil prices can have a significant impact on growth, and exceedingly low oil prices can cause concerns about the economy because, as we saw in the high yield chart earlier, oil companies could go bankrupt, energy companies could go bankrupt, and that could have a significant impact on the economy. Right now, oil is not a concern. We are in really a sweet spot, $60 to $70 range is enough to support a strong oil industry and also is not a great tax on the U.S. consumer. David?
So I'll take the last chart here. Just kind of, so what's the, when obviously, the recession does come, what generally is the ramifications? Obviously, it's a big number chart here, which I think goes against most presentation standards, but I think it's important to take a look at here. And if you really just focus on the middle of the page, I think it's, where you look at where it says magnitude of total decline. I think that's what we really want to pay, kind of close attention to when you look at the last, several recessions. The last two, obviously, being the dot-com bust and the Great Recession, those had meaningful peak to troughs in terms of, kind of what equities did. Dot-com close to a little bit north of 47%, and the Great Recession at 55%. The average overall, about 31, or let's call it 32%. I think you've got the vocal inflation one in there, which probably skews it a little bit to the downside in that number. But, it's generally north of 30. And again, obviously, we went through some pain in October. 20% didn't seem particularly, it wasn't fun, but you can recover. And based on what we showed you in the charts and where we are right now, you can recover 20% fairly quickly. The math is there for you. If you're down 20, you got to go up 25%. It gets a lot harder when you get out to the numbers in the 40s and the 50s. If you're down 50%, you got to go up 100% just to get back to even. That's how mean math can be. And so, when you start thinking about, and this is kind of why we're introducing it now, obviously, we perhaps could have waited a quarter, but we don't generally get as much audience participation in the summer, and then perhaps by the time you're in fall, it's a little closer than we need it to be. And so we thought this was obviously early, but wanted to kind of just show what some of the ramifications of this could be. The lines below it, I think, are important too, where it says magnitude of decline, which aren't recessions, but some peak to troughs, because I think these have been a little bit more in line with what we've currently seen. The one that is missing right now is the one that we had in 2018, which was, I think, just south of 20%. I think 19.6 is where it came out. So, if you're looking for the bear versus bull market, you're a little bit under that from a bear standpoint, but nonetheless, those averages are somewhere around 20, and those are different. 20 is a lot different than the average of 32, or again, something a little bit more meaningful, given what we've seen in the last two recessions. And again, when you take a look at where valuations are, they are fair. There's no doubt about that. But when all this kind of started, we were close to 18, 19% on forward and over 20% on 20 times on trailing. And you could see some of the impacts you can have when you get at higher valuation levels. So just want to kind of point to this and say, what's to expect, what we're trying to protect against. It's those top six that we're looking to protect against. Not necessarily those bottom four. We've been through those bottom four, now bottom five. I think we held serve as a investment strategies group from a firm standpoint of staying positive and staying with what our current allocation is. But as it gets farther out and we start to get serious about talking about a recession, portfolios are going to need adjustments, and we're looking to be able to stave off the challenges that come with that. So with Howard, just from some final comments, if you have any, and then we'll get out of here.
The final comment really is, this is why we have diversified portfolios, that we have portfolios of stocks, bonds, and some of you have alternatives in your portfolios as well. And the idea is we will make asset allocation changes, but it is in some ways an all-weather construct. If you stick with your knitting and don't panic in the drawdowns, over the long run, you're going to do well. History has shown that. We've gone well over a half hour. I really thank you for your time, and we hope this call was productive. If you have any questions, feel free to contact your relationship manager or your portfolio manager. They'll be glad to address them. Thank you.